Recently, I had a friend come to me with a situation that she was like, I don't know what to do, and I can't figure out how to do this. And she thought I might be able to help. So what was going on is that her parents were splitting up and they were selling her childhood home. She obviously didn't want to lose her childhood home, but they didn't want to keep it. They needed to make some money, needed to get out of the property, and she wanted to buy it. However, she had recently just put a lot of her own money back into her business, so she didn't have the cash to buy it. What we were able to do is use a little known strategy called a gift of equity. And a lot of families are looking at the housing market, looking at their kids, looking at their family, and trying to figure out how they can help give their kids or give their grandkids even a leg up when it feels so tough in the market. So by using a gift of equity, we were able to get her into the home, them out of the home, and she didn't have to come out of pocket with any money. So I wanted to show you a little bit about how this works and then talk to you about the different loan programs as far as some of the nuances of things that you'll have to keep in mind. So first, what is a gift of equity? So a gift of equity is when the seller and the buyer are related, and the seller is going to gift some of the equity, some of the profit that they have in the house to their family member that's buying the house, and that can either cover the down payment or the closing cost, or it can cover both. And usually it means that they might be selling the home for less than market value, because a lot of times what happens is the seller, the family member that owns the home, figures out what they want to get out of the transaction, what they need to make. And anything above and beyond that, they might be willing to give that as a gift to their family member. So as long as the home appraises for what they need to make, what the seller needs to make, and what needs to work for the down payment and the closing costs, as long as the home appraises for what those numbers are added together, then it can work. But this is what the numbers look like for my client's scenario as an example. So in this case, the parents wanted to sell the home for $300,000 and it was going to appraise for $300,000. So as long as the numbers work and the house will appraise, then you can use a gift of equity. In this case, we were using a FHA loan, and the minimum down payment for an FHA loan is going to be 3.5%. For a $300,000 home, that is going to be $10,500. For a regular purchase, this is what the buyer would need to contribute to the transaction. This is the down payment that they would need. With a gift of equity, however, the parents were able to cover this down payment through their equity. They had enough in the home where once their mortgage was paid off, they had enough equity that they could cover that down payment. The other thing that can happen is covering the closing cost. And so for this scenario, her closing costs were around $8,000. So again, if it was a regular purchase, if it was a regular transaction, she would have had the $10,500 for the down payment and the $5,000 for the closing cost. So in this case, her parents were willing to cover both. So they were both willing to gift the down payment, gift some of the equity as a down payment, and under seller concession guidelines or seller paid closing cost guidelines, they were also able to contribute the $8,000. They were able to sell the home, and she was able to get in with essentially no money out of pocket. So really, when we're talking about gift of equity, there are two things at play. We're talking about the gift of equity, meaning the extra profit that a seller has that they are willing to give a family member to cover their down payment. And then also, as long as they have enough equity, they can also cover the closing costs. But there are differences from program to program of how much a seller can contribute to the closing costs, regardless if they're related or not. For conventional loans, the max that a seller can contribute does depend on how much the buyer is putting down. So if you are a first-time home buyer with conventional, you can put as little as 3% down. However, mortgage insurance or PMI doesn't go away until you put 20% down. So sometimes if there's enough equity, the family member may decide to cover the entire 20%. So there's no PMI or private mortgage insurance. However, if somebody is putting the minimum down somewhere around that 3 to 5%, the max in closing costs that a seller can contribute is going to be 3% of the purchase price. If they're putting more than 5% down but less than 25, then the seller can contribute 6%, and the buyer is putting more than 25% down, or they're getting more than 25% gifted as their down payment, they can put up to 9% of the sales price towards closing costs. Now, most of the time you do not need necessarily even the 6% and certainly not the 9%. But if that's a situation where maybe they want to buy down the rate or do something else like a temporary buy down to sweeten the deal even more, that's good to know. But other than that, really from the standpoint of a conventional loan, as long as it's a primary home for the buyer, then all of the down payment and most of the closing costs, if not all the closing costs, can be covered through a gift of equity and that seller concession to cover the closing costs. Now, with an FHA loan, the minimum down payment as long as your credit score is 580 or higher, is going to be 3.5% of the sales price. FHA also has a higher cap on seller concessions or those seller paid closing costs, and that's going to be capped at 6%. Again, most of the time, we don't need all of that 6%, but it's nice to know that there's a little bit of buffer if somebody maybe wants to buy down their rate, or again, just sweeten the deal a little bit with a temporary buy down. So again, through either the gift of equity and the seller concessions, a buyer could purchase a home using an FHA loan with no money out of pocket. VA loans don't formally have guidelines that deal with gift of equity. However, as long as the deal is structured accurately, you're going to be fine. So VA does have a little bit of a different rule when it comes to seller concessions. Depending on what fees are being charged, what lender fees are being charged, those closing costs may be capped at about 4%. Most of the time, however, all closing costs can be paid by the seller, and it can even go above 4% depending on what that money is going towards in terms of the specific loan details. I know that that's a lot of word salad, but just from the standpoint of with a VA loan, much like with an FHA loan, pretty much the seller can cover all of the closing costs for a VA loan. Now, most VA scenarios, a down payment isn't even needed. So doing a gift of equity really isn't so much about covering the down payment, it's just about covering the closing costs. One of the cool things with a VA loan, and this has nothing to do with it being a gift of equity situation at all, is that the seller can pay off debts on behalf of the veteran. For example, something needs to be paid off in order to qualify. That can happen as part of this transaction as well. A couple things to keep in mind. Again, a gift of equity really has to do with the down payment, and seller concessions have to do with closing costs. So we want to make sure when we're looking at the loan type and marrying it up with buying from family and getting the gift of equity, that we know what money is going towards the down payment and what money is going to the closing cost, and making sure that it's allowed for that loan program. Also, buyers may need to pay for the appraisal, and I would still recommend getting a home inspection up front. Even if you're buying from family, you really want to know what you're getting yourself into. But even if you do pay up front for the appraisal and for the inspection, that can be refunded through the seller concessions or the seller paid closing costs, and that makes it a true zero money down transaction. Finally, the loan is going to be based off of the sales price. For example, in this transaction, when the sales price was $300,000 and the parents were gifting the down payment, we didn't reduce the sales price by that $10,500. That down payment minimum that needed to be met, the 3.5%, was based off of that sales price, the $300,000. So ultimately, it comes down to family helping family is a great way to build generational wealth and keep a home in the family. Particularly if it's a situation, a lot of times what I see is somebody buying grandma's home, and it's a wonderful thing to see the grandchild buying the grandma's home, being able to free up some of the money for perhaps, elder care or other things like that, while also still being able to keep the home in the family and a new start for the grandchild. So like I said, family helping family is a great way to grow generational wealth. It's just about being smart with the resources that you already have. If you found this helpful, please like and subscribe for more information like this. And of course, if you have any questions about how to use gift of equity with your own family, please reach out with any questions or feel free to comment here. I'll see you next time.